the Federal Reserve just made one of the most important decisions of 2025, adjusting interest rates. But what does that really mean for your money? From your savings account to your mortgage, credit cards, and even investments, interest rates shape nearly every part of your financial life. Today, we're going to break it down in simple terms, so you'll know exactly how the Fed's moves in 2025 affect you. The Federal Reserve sets what's called the federal funds rate, which is basically the rate banks charge each other for short-term loans. Now, you might think this has nothing to do with you, but in reality, that rate trickles down into the entire economy. When the Fed raises or lowers rates, it impacts borrowing costs, savings returns, and even how much companies invest and expand. Think of it like a thermostat. When inflation runs too hot, the Fed raises rates to cool things down. When the economy feels too cold, they lower rates to heat things up. If you're borrowing money, this matters a lot. Mortgages, car loans, and even credit card interest rates all rise when the Fed raises rates. A $300,000 mortgage, for example, could cost you hundreds more per month in payments. On the flip side, when the Fed cuts rates, borrowing becomes cheaper, which makes homes, cars, and business loans more affordable. That's why the Fed's decisions directly shape whether families can buy homes, businesses can grow, and how much debt costs you month to month. But it's not all bad news. If you're saving money, higher interest rates are actually a benefit. Banks often increase the rates they pay on savings accounts and certificates of deposit, which means your money can grow faster without you lifting a finger. In 2025, some online banks are offering savings rates we haven't seen in years, making it the perfect time to take advantage if your money is sitting in a low-yield account. For investors, interest rates play a huge role too. Higher rates can pressure stocks because companies have higher borrowing costs, which cuts into profits. At the same time, bonds and other safer investments become more attractive. On the other hand, when rates fall, stocks often get a boost because businesses can borrow more cheaply to fuel growth. Real estate is another big one. Rising mortgage rates make homes less affordable, which cools housing demand, while lower rates can heat things back up. That's why both investors and homeowners keep a close eye on the Fed. Interest rates also affect everyday life in ways you might not notice at first. Student loans, car payments, and small business loans all become more expensive or cheaper depending on the Fed's decision. Even the job market feels the ripple effects. Higher rates can slow hiring, while lower rates encourage businesses to expand and create more opportunities. So, what does all of this mean for you in 2025? The Fed's interest rate is like the steering wheel of the economy. If rates move higher, borrowing will cost more, but saving will reward you more. If rates move lower, loans will get cheaper, but your savings may grow slower. The key is that you don't control the Fed, but you do control how you respond. Paying down high-interest debt, taking advantage of higher savings rates, and diversifying your investments are smart moves no matter what direction rates go. At the end of the day, interest rates may sound like something that only bankers and economists care about, but the truth is, they shape your financial life every single day. Stay informed, stay prepared, and use the Fed's decisions as an opportunity to strengthen your own financial mindset.